Deal analysis. As I said in the last video, getting deal flow, there's really only two things you have to know in the real estate business, and that's how to produce deal flow, as we said in the Finding Deals video, and then how to analyze deals, what we're going to cover now. So if you can find them and analyze them, you're 90% of the way there. Funding is the third portion. We'll cover that later, but really it starts with deal flow and knowing what is a good deal. If you have those two things, you're pretty much off to the races. So in this video, we're going to discuss deal analysis, what is a good deal, what do the numbers look like, how do we do the calculation, and is a deal worth doing? So I'm going to kind of cover all that in this video, deal analysis. So there are three different approaches to valuing commercial real estate, two of which we use on a regular basis. The third we don't really use that much at all, but I'm going to show you all three of them just so that you understand how a appraiser or a lender or how you should be valuing deals and how to use these. So the first one that we're not really going to use is replacement cost or cost approach. This is the one that I'll explain so that you understand it, but it's not something we're going to make use of very much. Then we have the income approach. This is probably our biggest one here. We're going to use the income approach the most. And then we have comparable sale. And if all three of these together create the value of our deal. And again, an appraiser or someone is going to use all three. We are largely going to use income and comparable sale approach to create our value here, right? But the appraiser and the lender may add in that third one, replacement cost. So let's take a look at all three of these. Replacement approach or cost replacement approach, you'll hear it as cost approach, is a function of deciding what your property would be worth if you had a brand new building there, right? So we take the building that exists, we calculate what it would cost to replace it, tear it down and replace it with a brand new building, and then reverse backwards to its current market value due to its age. That's called depreciation. We'll cover that. All right, so replacement cost, again, is value. That's going to be the value of the property equals the replacement cost, or whatever that building would cost to replace in today's material, today's labor, today's construction costs, minus the depreciation, okay? Meaning now we're going to depreciate backwards or bring the value down to reach the age that it is. So if you have something, we're in the year 2021, if you had bought something and it needed to be built this year, the price would be high. But let's say your building was really built in 1985. The government has a depreciation schedule that's not really important. We're not going to cover that here, but it shows you how much you should subtract each year to bring the value back to its building cost of 1985 or value due to the age. Now, keep in mind that we don't depreciate land. Land is not something that gets older or worth less due to age. And that's what depreciation is. It's the government saying to us that yes, even though real estate typically goes up in value, they're saying, hey, it's a physical structure. And we know physical structures get older. And as physical structures get older, they become worth less. So that's what depreciation is. So the value is going to be the replacement cost of the new building minus the depreciation value, and then we add back the land value because again, land value is not depreciated. So that's the replacement cost. This is something you're not really going to do that often. It's something the appraiser will do for the lender when they typically send out an appraiser to inspect your property. They're going to do this plus the other two calculations. Something you can use this for as an investor or a buyer of real estate yourself is to kind of use this value to see, is the value in the market worth paying or not? So my point is, if the cost or the market value, let's just say the price of something, let's call it that. Let's say the price, if the price of an asset exceeds its replacement cost, it may not be worth buying. Basically what I'm saying is if I'm looking at buying a property and it was built in 1985 and it is selling for more per door than I can actually build the property for or replace it for, then I would have to say this value might be a little bit high. You know what I'm saying? Because you don't want to buy something for more than what you could build it for. So that's just something you want to kind of keep in mind as you're out here looking at values and looking at those per door prices. And this is from single family all the way up to multi and commercial. You know, when the purchase price exceeds replacement cost, be careful. That could mean that the values of those assets are getting out of line. But that's largely my opinion. But I would keep an eye on that. All right. So here's an example using replacement cost. We have $1 million purchase price here, or purchase replacement cost. So we're going to say that your building here, if we rebuilt it, would cost us $1 million. We're saying that it's a little bit older, so we're going to subtract $100,000 from the million to give us the depreciated cost of the building equaling $900,000. All right, that's bringing it back for depreciation. Then we're going to add back the land value. All right, and that brings us up to $550,000 here plus total value of the real estate property. So we have the land value of $550 plus our $900,000 valuation would give us a total of $1,450,000. Right, 1.45 million is what we would have here. So that's just a kind of a quick math estimate or example of how replacement cost is used. Again, other than just kind of an acid test or a gauge looking at prices in the market, not something you're probably going to actually do this calculation on very regularly. But moving on to things that you will use very regularly, the income approach. This is probably one of the most important techniques for valuing deals as a private investor or as someone out looking to buy real estate for yourself or for others, investors of yours. The income approach. All right, so basically what we're saying here is we're going to value a property based on its source as a source of cash flow, right? So we're going to say the more cash flow a property has, the more valuable that property is. The less cash flow, the less valuable. So that's what we're calling the income approach. It's coming up with a price based on how much cash flow this thing actually makes. And do we want to go through the time, the energy, and the effort to produce this cash flow? Is it worth it? So we have two calculations. It's going to be return on investment and return on effort. Is it worth it? Yes, we can all make money, but sometimes there's not enough money to be worth the trouble and the brain damage of going through all of this. So that's what we want to kind of answer in this video is what makes it worth it? How much cash flow should we see? And when do we actually pay what a seller is asking? So this is going to be the income approach. I'm going to give you an example of that, or I'll show you some of the basic formulas here. So we start off with the fundamental formula in all commercial real estate, even single family basically, that says income. So we got to look at the property's income. What is it collecting in rent each year? So we have income. All right, then we are going to minus from that our expenses. All right, so expenses. Now, when I say expenses, you need to understand that what I am talking about here is what we call operating expense or OPEX. All right, this is OPEX, OPEX. Operating expense, not mortgage. All right, so this is taxes, insurance, paint, carpet, unit turnovers, all those different things we're going to be using to calculate out our expenses, get rid of that. But it is not mortgage. So keep in mind, you're not supposed to take that into account doing that. All right, so we have income minus our expenses, operating expenses, as I said, equals NOI, or net operating income. All right, and that's what NOI, net operating income, and that is income minus expenses equals NOI. Now, the net operating income is what we have to pay the bank or pay our lender, and whatever is left over is cash flow, and that's ours. So now the formula is net operating income. Let's see, I'm going to start back over here. NOI minus bank payment, or what we call debt service. So that's payment All right. So net operating income minus your payment, debt service to the bank, equals cash flow. All right. Cash flow. There we go. All right. So that's roughly the formula. I tell you what I'll do. I'll clear this. We'll start all over again. So we have income. We'll do income minus expenses. Expenses equals NOI. NOI minus debt service equals cash flow. All right, cash flow. There you go. And that's roughly, that's the formula for calculating all real estate from single family to multifamily to commercial. It's going to follow this basic formula. All right. Once we've figured out how much cash flow we have, we now need to decide, is this enough cash flow? Is it enough cash flow to be worth our time, to be worth our energy? Is this enough return on investment? And is this enough return on effort? Okay, so let's break that down. Now that we kind of have this formula here, we're looking at cash flow. Okay, so let's say, is this going to produce enough cash flow for us to be worth it? What you want to do now is to calculate cash on cash. So we would take cash flow, so this is cash flow, all right, cash flow, and from that we are going to divide by the cash invested. So this is going to be all cash invested, I'll put that in here, so divided by your cash invested. Okay, but cash invested is going to include down payment, it's going to include any fees that you have to spend, your lender's fees, origination fees, all that kind of stuff. So it's going to be your total dollar invested. So cash flow divided by your total investment amount equals cash on cash. And you'll see that abbreviated COC most often. Cash on cash. This is our return on investment, right? This is the number that we have to start to decide, is it worth it or is it not? Do we want to do the deal for this amount of cash on cash or cash flow? The answer really comes down to, what is your cost of capital? What do you have to pay for this money? If this is just strictly your money, then you ask yourself, is this cash on cash a good enough return on your own money? You would say, can I get more of a return in some other aspect, a different deal? Could you invest the same dollar amount in the stock market? Could you invest it in some other investment vehicle and get a higher cash on cash? If the answer is yes, then this deal would not be worth your time and your energy to do. If the answer is no, this is a higher return than you're going to get in other deals, then the answer is yes, you do the deal. Now, if this is not your personal money, let's say we're going to bring on investors, we're going to bring on other people's money, then we have to ask ourselves, is this cash on cash number high enough to pay the investors and have some left over? So for example, let's just say that this cash on cash number was 15%, a high number, 15%. And your investors will invest in your deal for 8%, something like that. Then the delta, or the difference between the 8 and 15 here, the 7% would be yours to keep as positive cash flow. So that's kind of what we're doing. We're trying to calculate out our cash on cash, and then we have to ask ourselves, is that worth our time and our energy on our own money? And if it's not our own money, then we have to ask ourselves, what is our cost of capital? Cost of capital in this case would be 8%, because we know that's what our investors want to get. And then we're probably going to give them all of this cash flow until they get an 8% return. That would be considered a preferred return. We covered that in a later section. But basically, you're probably, to make this an attractive investment, you're probably going to have to give a lot of this cash flow to your investors to get them interested. And then you want to have some left over for you, because if this is 8 and this deal only produces an 8% cash on cash, and we know your investors all want to make 8%, well, then there's none left for you. That may not be that good of a deal, or that may not be worth your time and your energy. But that being said, I want you to keep in mind a few different things, especially if you're new to real estate and you're new to business. Yes, profit is good. Yes, making money is good, but keep in mind there are other benefits to doing some of these deals. Even if we don't get rich on our first deal or two, right? You're going to build a resume. That's very valuable. You're going to gain experience. You're going to show that you've closed. You're going to show that you've done a deal. And this is getting you going and getting your resume going so that you may wind up doing more deals in the future where you bring more general value and you command a larger piece of the cash flow. In the beginning, keep in mind that there are lots of profit centers, if you want to call it that, in a deal. Education, experience, credibility, all of these things. And then yes, ultimately cash flow, but don't just look at cash flow and say it's not worth it if you're not gonna get rich on your first deal. That's a limited point of view. We don't wanna have that. Definitely wanna make money, but again, keep in mind, you're probably not gonna make real money until you've done this a few times and you've kind of gone through a cycle once or twice of going through this. Usually your profit kind of goes up as your credibility and your experience go up. So just keep that in mind. But that's cash on cash flow. So quick recap, it's income, the property's annual income minus its annual expenses equals net operating income. From the NOI, we're gonna then pay the bank or our debt service, pay in the bank. What's left over is cash flow. Then we take cash flow divided by our total amount invested, and that's gonna be down payment plus fees. Also, you would need to include in this number renovation dollars. If you're bringing money in to actually renovate a property, it would go in this number here as well. We're gonna do a cash on cash calculation, which is dividing cash flow by investment. We figure out what is our percent return, and that gives us our indication of whether we actually think this is worth doing the deal or not. All right, so moving on. I'm gonna show you an example of that, just a quick one. So we'll keep some real simple basic math. Let's assume that you're buying a property for $1 million. We'll put that over here. So the purchase price is $1 million. That's what we're buying the property for. We are then gonna say, let's actually, no, I tell you what, I'll write this a little more clearly. Let's do it like this. We'll say $1 million, all right? That's our purchase price. Now we know we're gonna borrow 80%. So we're gonna put down, let's call it $200,000. All right, so if this is our price here, this is price, and this is down payment, okay? And I'm not adding fees and things, I'm just keeping the math simple. We would be getting an 80% loan to value here, right? That's 80% loan to value if we were only putting down $200,000, right? Because 200's 20% of $1 million. So we're borrowing 80% from the bank, $200,000 down, okay. Now let's assume that let me clear this. We'll assume that our property is producing $100,000 a year, okay? That's not how you write 100,000, hold on. So 100,000, okay? So this is gonna now be our income, okay? We're gonna say that our expenses, remember operating expenses only, we'll say our operating expenses are 50,000, all right? So 50 grand. And that would leave us with an NOI of 50,000, right? So 50 grand. This would be our net operating income here, here. So we have $50,000 NOI. Now we got to pay our bank, right? Because we borrowed that $800,000, excuse me. So from the 50,000, we're going to minus our $30,000 payment to the bank. Again, clearly, I'm just making numbers up here. You'd probably have a bigger payment than 30 grand on $1 million, but not the point. So that would leave us with $20,000 cash flow. So we have 20 grand. All right, so there's $20,000 net cash flow from our formula here. All right, we know that we had to put down the $200,000. So then we would say 20,000. So this is our $20,000 cash flow. All right, that's cash flow. Right? Cash, I think I'm missing a letter in there, skip it. $20,000 cash flow. We're gonna divide that by our $200,000 investment, okay? So that would give us a 0.10 zero number there, right? So that's going to show a 10% cash on cash return. And that would be cash on cash. So in this particular example, if we bought the property for $1 million, we put down $200,000 and it cash flows 20 grand a year, we're getting a 10% return on this $200,000. Now, keep in mind, this example here is a cash flow calculation only. What I am not calculating is what we call our internal rate of return, or IRR. Okay, I'm going to go into that in the advanced section, but just so that you know, there is a difference between cash on cash and internal rate of return. Most people only calculate this cash on cash, and that's fine, but that's showing us the amount of profit that we're getting only from cash flow. Internal rate of return is also going to take into account how much profit we make at sale. And so, roughly speaking, and don't yell at me if you're an accountant here and I get this wrong, but basically what we're saying is we're going to take all of the cash flow for our entire project. Let's assume we hold the deal for 5 years. We would take 5 years worth of cash flow plus whatever money we made at sale, all that profit. We'd add it all together plus our tax write-offs, our depreciation for owning real estate. We'd add all that up and we'd divide it by the number of years that we held, and that held the deal, and that would give us our IRR. This is a little more difficult to calculate. Typically, you might need a calculator to do that, or an accountant if you're talking about using true depreciation. So not something that we calculate that much, but I just wanted you to know roughly the difference between cash on cash and internal rate of return. This 10% is not a calculating profit at sale. So it actually would probably be a much higher number in the internal rate of return comment, but cash on cash, 10%. So now we would have to ask ourselves, okay, if we're making 10% on cash flow, what is our cost of capital? If we know that our investors want 8%, then this deal technically works, right? Because we know that we're producing 10% and we're going to pay our investors that 8%, and you would keep a net 2%. And you think, gosh, 2%, that's a low number. Yeah, but don't think in terms of percent. We don't know how much cash flow that actually would be, right? That could be $1 million if this thing produced $100 million or something like that. So point being is you don't look at just percents. Figure out how much that actually equates to in real dollars and ask yourself if that's worth your time and energy. It would technically work as far as paying the investors per this calculation. It would. And if all of a sudden our investors wanted, let's say our investors want 12% return. Oh, see, then you would be at a negative 2%, and then technically that deal would not work, right? So the idea is to calculate up our cash on cash using these formulas when we're looking at a profit and loss. We're looking at the the seller's numbers, the seller's financial data. That's what we're after. Their profit and loss. And you get that profit and loss, and you find out how much did they collect. You do your calculation, and then you ask yourself, is that cash on cash going to be a big enough number to feed the investors with a little bit left over for you? Whatever's left over for you, you have to ask yourself, is that worth your time and your energy? Because this, ladies and gentlemen, is ROI. That's return on investment. This right here to you is return on effort. All right, because if you're using someone else's money to do this, you have to pay them for the use of their money, but it's not really your money. So you don't really technically care about the ROI. You care whether that's enough actual cash dollars to be worth your time, energy, and trouble. And again, like I said, it's not always about money. Sometimes there's resumes and other things that we can do to bring value, or to bring value to ourselves through a deal. So we just want to make sure that that's all worth your time and energy. Now, let me take a sidebar for a minute and suggest that you don't really bother doing this calculation yourself. Get a template. Get a deal analyzer template. Use one that you can enter the income, you can enter the expenses, you can calculate your mortgage payment, and that tells us how to analyze a deal. Now, and let me back up and cover that. I kind of made up a debt service number. You wouldn't want to do that. In real life, what you will do in this deal is to look at the income, look at the expenses, calculate your net operating income, and then use a mortgage calculator, which is typically built into a deal analysis template. But if not, use a mortgage calculator. You got to figure out what is your down payment. So you would want to be kind of talking to some local lenders or banks, just figure out, because that changes. It's not always 80%. Sometimes it can fall down as low as maybe 60%. 80 is usually on the high side, but it changes, and it depends on the borrower and the deal. Usually that's what makes the most difference to a lender. So stronger borrower, probably going to get a better loan. Lesser borrower, lower loan. Either way, you want to talk to your bank. You want to find out what the current interest rate is, what the current amortization is, and how much down payment are you going to have to put. When you get that data from your lender, all you do is just plug that into your mortgage calculator, calculate up the annual debt service at that purchase price. And that's when you find out, well, we're going to pay the bank this. It leaves this amount of cash flow, and then we decide, is it worth it or not worth it? If you do this calculation and you get a number down here, you get a number down here at the bottom that is not a good enough number. You know, it's either negative or the number is too small. There's two things you can do: pay less and borrow less. All right, borrowing less is not usually a viable option. So my ultimate point is, when you do this calculation, and always start with the seller's asking price. By the way, whenever you're looking at a deal, just start off with the asking price and go from there. Take the asking price. When you find that the number is low or negative or not a high enough cash flow to pay your investors and be worth the trouble, you want to lower the price. And so what I recommend is that you start off with that asking price, do your calculations, see what you get. Not a good number, then you just start rolling the asking price down. So let's say $1 million, try 900,000, see what kind of number you get here. If you don't like it, try 800,000, 700,000, 600,000. You keep bringing the number down until that cash on cash comes into a range that works for you. That is going to then tell you what your strike price is, okay? Strike price is a term that we use to define the number that we will not pay 1 penny more than. You know, strike price plus $1 and we walk away. So that's the absolute most you would pay for the deal. And that's what you've calculated here by rolling that purchase price down to figure out, to make it calculate out a decent return on investment. You're calculating your strike price. What I would recommend is that whatever you figure out that strike price is, offer about 10% less than the strike price. That way you have some room to negotiate. You can come up, because remember, once you get to the strike price, the deal's over and you have to walk away because it no longer produces a viable amount of cash flow. So that's strike price. That's what we're doing here. We're trying to figure out what we want to pay for the deal based on our cost of capital. Keep in mind, not everybody's cost of capital in the world is the same. So if you are ever bidding on a deal and you see someone else pay a lot more for that property than you paid, and you're looking at your calculation going, what am I missing? How could they have done the same math and paid so much more than I was willing to pay? It looks like they're going to get negative return or no return. That might not be true. We don't know where the other person's money is coming from. We don't know what their cost of capital is. They may have a ton of money laying around that they're getting no return on, and they just want to get it into real estate. They may be in a 1031 exchange where they have sold a piece of real estate, and now they're going to pay a whole lot of taxes if they don't bring this money into a new deal. 1031 exchange is not part of this. You can kind of research that on your own, but basically it's a tax deferred exchange. That would motivate somebody to pay more for real estate because they're going to lose a bunch of money in taxes if they don't. Foreign investors sometimes can get a really good exchange rate by bringing money into the U.S. So therefore you may find foreign entities that bid higher for American assets than locals will. So that's one that you'll see where you'll get beat. It happens. I mean, sometimes people just don't know what they're doing and they just pay too much. I mean, there's that. So point being is you want to stick to your math. You want to figure out what works for you, what numbers work for you, and stick to the math. Do not chase deals. If you go chasing deals and just trying to what I call pencil whipping a deal, which means making all this look really good on paper, but might not be so good in reality or might be hard to attain in reality, you're going to get yourself in trouble. So don't chase deals and don't try and keep up with everybody else in the market, especially if you see someone else paying a lot more than you did. Don't beat yourself up and think you did something wrong or your math is wrong because they paid more. It may be just their cost of capital is much less than yours. That was a lesson that really took me a long time in the business to get my head around. I kept getting beat on bids, and I always wondered how these people paying so much for this real estate. It just doesn't make any sense. Nobody's making any money. I was wrong. They were making plenty of money, just cheap cost of capital. So there you go. All right, so moving on. Understanding cap rates. All right, this is something I wanted to discuss real quick. Cap rate. This is a very important concept, and cap rate stands for capitalization rate. Okay, so functionally, the formula for cap rate is NOI It's going to be NOI, net operating income, divided by the price. Price. Or value or price. So I'm going to just say price in this regard. Sometimes you will see this written as value, meaning what the value is in the market. But it's basically your net operating income divided by the total price of the deal. And what cap rate is telling us is, in layman's terms, how quickly, if there were no debt, how quickly would this property pay itself off per the NOI. Now we know in 99.9% of the deals out there, you're going to go get a mortgage, so that's not really applicable. But basically, the formula would tell you that at this NOI, if you had an 8 cap rate, it's going to take you 8 years to pay that loan or pay the value of the property back from its NOI. All right. The way we use cap rate, really, more layman's terms, is to use it as a comparable sale sort of approach, okay? So cap rate is showing us, again, in a functional sense, it's showing us how much other people in the market value a stream of cash flow produced by that asset class, okay? So if I'm paying a lower cap rate, then I am paying more for that property than someone else. Right? So typically the lower the cap rate means the higher the price based on that NOI. So if you're paying an 8 cap rate for an NOI and I come along and say, well, gosh, I'm willing to pay a 7 cap rate for that NOI, then I am paying more for the same property than you're paying. And if someone else comes along and says, hey, I'll pay 6 cap rate, okay, then they're paying even more for the property. Now, understand that typically speaking, at least from the cash flow perspective, I am not discussing appreciation, but from the cash flow perspective, the more you pay for a property, the less the return is going to be. Why? Because you're bringing more down payment, you're bringing more capital to the deal, and so your cash on cash will decline or shrink as your cap rate also goes down. So cap rate is an inverse relationship. Typically speaking, the lower the cap rate, the more valuable the property, but the less cash flow it's going to have. Typically speaking, as you go into older buildings or lesser valued properties, that cap rate will go up, but so will the cash flow, because the appreciation may not go up as much. So if you're talking about a brand new property, a newer asset, it's probably going to have a low cap rate compared to a property that may be much older. Maybe it's in a tough neighborhood, maybe there's a high crime area, things like that. Those properties, in theory, should have a higher cap rate than the brand new building that has a lower cap rate. Now, the brand new building is going to appreciate quicker, generally speaking. It's going to appreciate a lot quicker, but with less cash flow because it's newer and it's going to have a higher price. That older building is not going to appreciate as much, but it should cash flow a lot more. Now, again, that's in theory. What can make that change or do different things is market cycles. We'll cover that in the market cycle section or in the 3 pillars of real estate video that I'm going to do. But basically, cap rate, is looking at how we all value that source of revenue in a property or in a market. So let me say that let's kind of do a quick test. If I'm buying something at an 8 cap, and these are always presented in percent, by the way, and everyone else in the market per that same NOI formula, everybody else in the market is paying a 6 cap rate. Let's just say, now I'm buying it at an 8, and everybody else is paying 6 for similar properties. This gives me an idea of whether I am paying more or less for the same building than everybody else in the market. So let me ask you, if I'm buying it at an 8 and everybody else is buying it at a 6, am I buying the property for more or less than everybody else in the market? I am buying the property for less than everybody else in the market, because remember, the cap rate is higher. So higher the cap rate, typically lower the actual price. Okay, so if I'm buying it at 8 and I know everybody else is buying it at 6, I'm getting a good deal. Reverse that. If I'm buying it at a 6 and everybody else in the market is paying an 8, then I am paying more than everyone else in the market, right? But we have to kind of keep in mind here, just quickly, that the net operating income is what dictates that cap rate. It's the ratio between the net operating income and the price. What if a property has low revenue for some reason? It's a distressed asset. Maybe the occupancy is low. Maybe the rents are low. You may see a low cap rate, but that's okay, because if we increase the NOI, if we bring up our revenue, then the cap rate decompresses, it gets larger, right? So let me give you an example. One of the best deals I ever did was about a 2 cap rate, right? And you would think, gosh, that's a really low cap rate. Like, how in the world do you make money buying a 2 cap? That's absurd. No, it wasn't, because the net operating income was based on this property at 60% occupancy. All right, so I'll give you, see if I can write this up here. I'll give you some quick examples. So this property's NOI was, I don't remember what it was, like $100,000 or something like that. I'm gonna make up some numbers. But basically, this was the money that we were collecting at 60% occupancy, you know? And so when I did that price, I think the price was like $4 million. I'm gonna kind of make up some stuff for this example, but price is about $4 million for that property. And at 60% occupancy, it was producing $100,000. And when I did the calculation, the NOI and cap rate calculation, I came up with something like a 2% cap, which is really low. But that's okay, because I said, look, this is the cap rate we're getting per today's price based on the NOI being produced at 60% occupancy. What if I can get the occupancy up to 80%? What is the number then going to be? And that's when we came up with, okay, first of all, let me stop and say that. So the property was at 60% occupancy. I looked around the city. I went up and down the street. I looked at all these other properties in the area, and I said, what is the general occupancy in this entire city? And it was about 97% occupancy. So why was this person at 60% occupancy when everybody in the whole city was at 97%? And that's when I said, okay, the 60% occupancy that we're seeing here is not real, because we can actually get that property up to about 97% occupancy, because I've already looked at everybody else and everybody is actually at that number. Why was this person at 60% occupancy? Well, it was an older gentleman. He had owned the property for about 30 years. He had had no bank payment for 20 years. He was cash flow, and everything the property was producing was just net cash flow to him. He didn't really care. He was just mismanaged. He just didn't care. And so what I realized was that I could buy this property at the $4 million price, at the 2 cap rate, at this 60% occupancy. But as soon as I got the property up to the occupancy that was everywhere else in the market, all of a sudden that income, I think it doubled or something. It went to like $200,000, and all of a sudden our cap rate down here was huge. It wasn't a 2 cap rate anymore. All of a sudden it was back up here at that was like a 12 cap or something, I think. I mean, it was something huge. It was like a 12% cap rate. I'm kind of making numbers up roughly because I don't exactly remember. But my point was, we bought it at a 2 cap rate. right? We turned it into a 12 cap rate by bringing the occupancy from 60% to 90%, which brought our net operating income way up. And then I was able to turn around and sell the property at an 8 cap rate. And the profit was the difference between the 12 and then compressing back and selling it at an 8, right? So we basically bought the property at $4 million and it was a 2 cap. But when we brought the occupancy up and the NOI up, the next investor was able to come in and do this calculation based on our new number. And we sold that property for almost $8 million, doubling our money. And we did it in about a year and a half or so, right? So this was just an example of how cap rate works and how sometimes a low cap rate is not necessarily a bad thing. You have to ask yourself, why is the cap rate so low? It's usually two things. It's either going to be that the NOI is too low, right? So it's going to be a low NOI. That's why your cap rate is low. Low NOI, right? Or high price. Those are usually the two reasons you wind up with low cap rate. Either you're paying too much for that property or the NOI is low. Now, if the NOI is low, I like that because that means that the price is probably fine and I have the ability to raise this NOI and over time I'm going to be able to bring the NOI up like that, right? And so starting off down here, yeah, I started at that 2 cap rate, but then it went to 6, 8, 10, 12, right? And I was able to sell it back down here for a large profit. So this is a value add deal or something that you're going to renovate, something that you're going to bring the NOI up over. Now, this is a good deal, in my opinion, to find something that you can bring the NOI up on. You can do this by raising occupancy. You can do this by raising rents. You can do this by lowering expenses, right? But if it's a high price, there's not much you can do about that. So all you can do is just pay less for that property if it's not calculating out a correct cap rate. But keep in mind, cap rate is a relationship of our net operating income to the price of the property, and it's a function of looking at what everyone else is paying in the market. If everybody's paying an 8 and you can buy something at a 10, you're getting it at a good price. If everybody's paying an 8 and you're paying a 6, you're paying too much for that property and you want to be very careful. So it's a way of kind of telling what everybody in the area is or is not paying for real estate. Now, let me show you something else. This is a different concept here, a little more advanced. Cap rate, as I've shown you in the formula, is a function of increasing the net operating income. So what it should look like is if we can raise revenue like this, okay, over time. So we understand that this is time going this way, right? And we keep our expenses relatively level while raising rent. So we're going to call this revenue. I'll just call it revenue, although we know that's mostly rent. And this is going to be expenses here, right? So if you're keeping your expenses here, then what we're showing is the net operating income, the delta between revenue and expenses, is increasing year over year, right? So it's getting bigger, just like this. And so what that's showing is how the cap rate ultimately decompresses. So let's say we bought this property at a 4 cap rate, it'd be kind of low, but we're able to keep our expenses good and we're raising the rents all along. Well, that turns into a 6, an 8, a 10, and so forth and so on. And the longer that you hold that property and the longer that you're able to raise the revenue and keep your expenses relatively low, the faster your cap rate decompresses. And as it decompresses or gets larger, you're creating value in that property. What you want to see is that cap rates stay a lot lower than whatever you've operated to. So if cap rates stay between 6 and 8 here, and you can operate all the way up to a 10 or a 12, then you'll be able to sell that back at that lower cap rate, and that's going to create profit at sale. That's capital gains. It's not cash flow, but it's capital gains, right? So this is kind of the idea. Let me kind of start that over. So the idea being, if you can get your revenue going up by raising rents, right, then your cap rate over time decompresses. But what if expenses go right on up at the same level as your cap rate or as your revenue. No decompression. And you buy that thing at a 4 cap, it stays a 4 cap for the entire time. And ladies and gentlemen, that is not a 4 cap, that is a foreclosure. Be very, very careful about this. Where would we see this? Where would you see a property that the expenses go up and the revenue goes up and the expenses kind of go right on with it and the expenses don't hold level like we talked about? What kind of deal would this be? An older building. Yeah, because older buildings are going to have expenses increase over time at a more rapid pace than a newer building. So my ultimate caution to everyone here is be careful about buying something more than 50, 60 years old. So today that would be things built in the 1960s, the 1970s. If you're buying those at a very low cap rate, something like that, and you're in the 1960s and 1970s product, be very, very careful. You're going to have these expenses go right along up with your rent growth. And yes, you can raise rents, but you're not going to keep any of the money because it's literally going to go into the plumbing and into the roof and into the parking lot and into the paint and carpet and into the tenant that moved out. So this is actually going to be what we call CapEx, not OpEx. All right, so OpEx is operating expense, CapEx is capital expense. Now, there is a big difference between OpEx and CapEx. CapEx is a large ticket item like replacing a roof, redoing your parking lot, redoing the electrical or the plumbing in a building, things like that. So it's not the same thing as operating expense, but your bank account doesn't know the difference. Your cash flow doesn't know the difference, right? The government says replacing the roof is CapEx and you get to, take that off of your future taxes and this, that, and the other. Who cares? Your bank account doesn't have the money in there because you spent it on a new roof. Simple as that, and that's real straightforward. So be careful when looking at older buildings that are selling at a very high price because you may be misunderstanding the infrastructure needs of that building. And if you miscalculate that, and your expenses go up along with revenue, you're not decompressing that cap rate. And then the only thing you can do is compress the cap rate further. Meaning if you bought it at a 4 and you did not raise the rents or you did not, let me rephrase that, if you bought it at a 4 and you did not increase your net operating income, because you may have increased rents, you might have, but the expenses went right along with it, then you never decompress the cap rate and now you've got to sell it at a 2 or a 3 to make money. So be very, very careful about that concept. If you're buying something at a low cap rate and you don't increase the NOI, the only way you're going to make money is by selling it to someone else at a much lower cap rate. And the cap rate's getting down, and these kind of numbers are pretty low, meaning the return on investment is low, meaning the return on effort is low, and therefore may not make this a very attractive scenario to a new buyer. So we got to be very, very careful about this. This decompression works real well in newer buildings, not so well in the older buildings. So my ultimate point is there's nothing wrong with owning affordable housing or older assets. There's nothing wrong with that at all. We just got to be real careful about what we're paying for them. Don't overpay for real estate. That is the gift that we'll keep on taking for a long time. So be very careful with that one. All right. So comparable cap rate, we kind of hit this one. It's about looking at what other people in the market are paying. If you're paying a 6 and they're paying a 6, then you're paying about the same price as everybody else, or you're at least valuing the stream of income at the same rate that everyone else is. If you're paying more, if you're buying at a higher cap rate, you're actually getting a better price. If you're buying a lower cap rate than everybody else, you're getting a worse price. So pretty straightforward on that one, comparable cap rates. All right, moving on, we're going to talk about the comparable sales approach. This is very similar to cap rate in the sense of what is everyone else paying? If everybody else is paying $100,000 per apartment and you can buy a very similar property for $80,000 an apartment, then you're paying less than everybody else. And if you're paying $120 and everybody's paying $100, you're paying more than everybody else. This is the comparable sales approach. And it's just a function of looking at price per, what we call price per pound, right? You're kind of at the meat market and you're walking along looking at what is that price per pound, and comparing it to other things on the counter. Well, real estate's really no different, right? It's price per door, price per unit, price per pound, same thing really, right? So let's talk about what is a comp, or what is comparable data, because this is something that you got to be really familiar with. I see people misunderstanding this a lot, and if you misunderstand this, the likelihood is that a realtor is going to be able to feed you data that may not be, I don't want to say dishonest, but may not be exactly accurate. So we've all kind of heard the problem with statistics. Right? Statistics can be manipulated pretty easily. We can not lie, but we can add or omit data as it helps to profile our property. So this is what I see going on a lot of times when working with realtors or looking at property packages. Not picking on realtors, but this is what I see most often, is that you may have a property, right here, your property is right here, and then the realtor shows you some deals that are here and here and here and one over here, because these properties really justify you paying that price for this property. Sure, but what about all these other properties that are all right around in here? Did you look at those too? No, they just left that data out, because you know what? That property and that property and that property and that property and that one and that one and that one and that one don't justify that price. So it's not to say that by adding in or leaving out data, someone is lying to you. They're just not telling you the whole story. So when you are looking for comparable data in a market, these are the four main categories that you want to watch out for. And I'm going to show you how to kind of make sure that the other properties you're looking at or being shown as far as comparable data is actually comparable to your property. All right, so number one, we start off with age. Really important. I say that you should be plus or minus 10 years. All right, 10 years. So therefore, don't look at a property. So what I'm saying here is a comparable property needs to be within a 10-year over-under window of the date of construction of your property. So if the property you're looking at was built in 1985, then you would look at properties that were from 95 to 75, 10 years older, 10 years younger, around that range. If you're looking at something in year 2000, you don't want to, or let me back up. If you're looking at something built in 1965, you don't want the realtor to show you a property that was built in the year 2000 and have them say, oh, that's comparable. It's not. It is not comparable in age. Newer buildings typically get better rent and have more appreciation than the older ones. So that's why we got to make sure it's a real apples to apples comparison here, right? So that's where I say you want to keep your construction date within 10 years over under of whatever your property is, comp data. All right, size. I'm saying plus or minus 20% in size. All right, so now we're talking a little more about like multifamily. If I'm looking at 100 units, then I don't want to look at anything less than 80 units or more than 120 units. Let's do that. So that's what I'm saying. If you're looking, so it's 20% over under. If you're looking at 50 units, then you would look at maybe 60, 65 units, whatever that number is, or a few under. You get the idea. So plus or minus 20% in size, and that's going to be a unit count. So don't let a realtor or someone else show you a 20 unit property and say, hey, you should buy this 20 unit property because there's this 100 unit property down the street that did this, this, and this. See, and therefore you should pay a similar price for this 20 unit because someone paid a similar price for 100 units. Those are not going to be comparable properties and you're going to wind up overpaying. Now, what is the biggest issue with the discrepancy between a small property and a large property? Amenities. And that's the next one. Because typically your larger properties are going to have better or bigger amenities than a smaller property, and that's really important. So if I'm over here looking at a 20 unit apartment complex, that's not likely to have a swimming pool and a fitness center and a business center and a dog park and the community garden and all the little things. Yeah, but if I'm over here looking at a 200 unit apartment complex, it is very likely to have all of those things. So that's where I kind of say amenities. What we're going to say here is like kind. All right, like kind. So if I'm looking at a 20 unit property built in the year 2000, I want to see that it's close in age. I want to see all the comps that are no more than 20 units, over under or so, 20% over under. And then I need to see that the amenities are similar to the ones I'm looking at. So again, if someone shows me this 20 unit has no pool, no fitness center, no office, none of these things, and then they're showing me these properties all around here who come with all these other amenities, you're gonna get more in rent for the property that has better amenities. And then the realtor or someone may say, seller may say, gosh, see, look, they're paying this for these properties, or they're paying this cap rate for those properties. Therefore, you should also pay the same cap rate. And I'm saying, no, you should not, because you're never gonna get that rent. Another one here, don't let someone tell you the rent is below market and then compare it to a property that isn't really comparable and tell you, hey, because this 100 unit apartment complex that's brand new with all the nice amenities is getting $200 more in rent than your property that's 20 units built in 1963. Therefore, your rents are below market. Be careful with that. You really want to kind of make sure that you're comparing your apples to apples, or you're going to overpay for the building believing you can raise the rent, only to find out you can't raise the rent when your property manager tells you, yeah, if we had a pool and a business center and a fitness center and all these other things, we would also get that rent. Oops, too late to find that out. Location, that's the final one. All right, here you want to be in a 3 to 5 mile radius around your property, okay? So what I'm saying here is, if this is our subject property here, you want to look at all the properties in there, maybe a 3 to 5 mile radius around that property, like this. This could be your 3 mile, and this could be out to your 5 mile here. Now, something I want you to pay attention to here is, if this is our building, all right, how much city is in this 3 to 5 mile radius. So we'll call this 3 and then we'll call this 5 here. So what I'm basically saying is, what is the density of population? All right. So the more population, the closer to the subject property you want to look at comps. Okay. For example, I'm in Atlanta. If this property were in downtown Atlanta, and you showed me a property 5 miles away, I'm not saying it's not comparable. I'm just saying, in a straight line in Atlanta, will cover millions of people for 5 miles. City of Atlanta, I believe this is like 2 million people in here. And then you kind of get into our metro area, you're talking more like 6 million, roughly. And so point being is that if there's 2 million people in a 2 mile straight line, 2-3 mile radius here, there can be lots of different kinds of neighborhoods, lots of different changes, lots of demographic changes. You can cross a street and have $1 million homes, cross the next street, be in a war zone, cross 2 more streets, you're back into the $1 million homes. And so this is where I say you got to be careful. You want to, you want to make sure, I'm all over the place here, make sure that your property here, that you're looking at the comps as close to your property as you can, ideally, no more than 3 to 5 miles away total, and pay attention to the amount of population. If that same deal were out in, Oklahoma, North Texas, something like that, a very rural area, you might be able to go 3 miles and then come out another 5 miles, and you really haven't covered very much population between here and there at all, right? So that could be very fine. It could be fine to be looking at comps, maybe even out a little further. If one of your other properties that you're looking at comparable data is here, and one's out here, and one's over here, that's fine. But again, the more people, the more density, the closer you want to be pulling those comps. Don't let a realtor show you something in Atlanta that's 10 miles away and then say that's a comparable neighborhood. I'm not saying it's totally wrong, but I'm saying be skeptical. So 3 to 5 mile radius at most, and pay real close attention to how many people live in that 3 to 5 mile radius and how quickly those neighborhoods change the faster they change, the closer you want to be. Because again, I see people make this mistake all the time. They'll say, gosh, look, here's this property here in Atlanta, and right down the street, there's $1 million home. So this is a great neighborhood. And like, whoa, wait a minute. That house is 2 miles away. Do you know how many different neighborhoods you can cover in the density of downtown Atlanta in 2 miles? It's crazy. So that's just an example. Like I said, that's where I would be careful about using location and having someone show you comps that are way, way far away. So 3 to 5 mile radius, there you go. All right, let's talk about return on effort and return on investment. I believe we've covered this one already. ROI, return on investment. That is the calculations that we've been doing as far as cash on cash. And IRR, you know, is it going to cover our investors? Are they going to make money? Are we feeding everybody that's involved in the deal? Yes. And then ultimately, is it worth our time and energy? Is there enough cash flow left over for us? You know, I've done some deals where I work for free. I have. I don't recommend it, but I've done some, not intentionally. But nonetheless, even the deals that I didn't really make a whole lot of money on moved my resume. They moved my credibility forward. Other people in the market, sellers and realtors, saw me closing a deal. They would call up and say, hey, we saw you close that deal. We have some other deals for you. So just keep in mind that it's more difficult in the beginning, but once you get that first deal down, once you get going and you really get the things up and running, you get your resume built, the deal flow comes much, much faster. Now, I'm not suggesting you just go out and close a deal just for the sake of closing a deal, but I am saying that it gets a lot easier after the first one. And then once you get on paper as having done a deal, believe me, other people in the market see that. Realtors track these closings. You will start getting phone calls. Hey, I see you closed 123 Main Street over there. I've got another one over here. Are you interested? It's easier to go to investors. It's easier to go to sellers and say, hey, look, I've already done this. So just keep in mind that profit, dollar cash profit, is good, but should not always be our focus, especially when we are new to the business. Now, as time goes on and you do more and more deals and your resume is built and your credibility is built, yeah, then you want to focus a lot more on the return on investment, less on the effort. But in the beginning, very important concept. Don't just chase dollars alone and skip deals that could move your career forward. That's not a good idea. Okay, so what is a good deal? We've talked about that. What is a good deal? Well, it is cost of capital. I mentioned that. I'll write that again. So we have cost of capital, all right? Cost of capital. We know that, again, well, let's see, I'll do this. 80% of our cost of capital, 80% of our cost of capital, well, let me say anywhere from 70 to 80% traditionally, all right, is going to be our loan to value, all right? That's our cost of capital for our 70 to 80% of our deal is the money that comes from the bank. And that's going to be our interest rate. So that's going to be whatever the interest rate is. Interest, something like that, rate, all right? Interest rate, excuse the handwriting. So 70 to 80% of the deal, the cost of capital is going to be whatever the current interest rate is to the bank, okay? The rest of the deal, the 20, let's say 20 to 30%, I guess I should say, to 20, write that backwards. The down payment, the cost of this capital is going to be either your return on investment, right? Or the cash on cash to our investors, either one. And it's always going to be cash on cash, cash on cash. Hold on, I should write that a little more clearly. Cash on cash equals the return on investment. That's what I should say. So let's do that. Let's say cash on cash equals our return on investment. I'll write it like that. So the down payment, this is the part we're going to be most concerned with, because going to the bank and getting a loan, that's its own entity, that's its own problem. But raising this money either from yourself or from investors, you've got to make sure that the cash on cash equals a high enough return on investment to attract these dollars. So if you want to use investors, if you want to use someone else's money to do some of these deals, one of the first things you need to do when analyzing deals is to start networking. Start asking these investors, hey, you know, what kind of return would you want to see for you to be interested in getting into a deal with me? And you find this out early on. so that then you're armed with this information and you can go out and find deals that hit these two numbers and provide that for these investors. Because basically the concept is, if we can use the skills that I'm teaching now, if you can use the skills that I'm teaching you now, and we can go out and find deals that produce these returns, you'll be able to go out and get money from people to help you do this and close more deals. And this is what we call a syndicated deal or syndication. I will cover that in another section, but that's using investors' money as a down payment. And so it all comes back down to how much money am I going to make? And let me make 2 points here about price. No one cares. Nobody cares what the price of real estate is. I swear they don't. They care how much money they're going to make from the price of that real estate. Because I could tell you, hey, this property is $1 million per apartment. And you go, oh my gosh, that's a terribly high price. But what if I turn around and tell you, yeah, but you're going to double your money in a year? Yeah, that might not be such a bad deal, right? So don't get stuck on what the price of something is. Pay attention to what the value is. And the value is based on how much money we're going to make from that deal, right? So that's concept number one. Concept number two, when you are bidding on real estate, when you're bidding against other buyers, whoever is willing to accept the lowest return wins, right? And so think about it in that regard. When you're bidding on a property and you're bidding prices and you're bidding against someone else, you're not actually bidding on the price of real estate, you're bidding on the return. You're saying, hey, I'm willing to accept a lower return, so I'll pay more. Well, hey, I'm willing to accept even a lower return, so I'll pay even more than you will, right? So that's the concept there, is that we don't care what the price is, we care what the profit is, we care how much money we're gonna make. And keep in mind that when you're bidding on a price, it's not, again, really anything to do with the price, it's the returns. And whoever bids the highest price and who has the cheapest cost of capital typically wins in the bid process because they can tolerate the lowest return. So those are just two concepts I want you to keep in mind when you're out thinking about bidding in real estate and to come up with the price of something. All right, let's go over a review real quick. And end it. We talked about deal flow in that first segment, in the first video. You got to get deal flow. You got to go out there. You got to be getting at least 3 to 5 deals in the door every week. All right, and then when we have these deals come in the door, you need to be getting the financial data. I talked about how to do that in the Getting Deal Flow video, going out there, working with realtors, working directly with sellers. We're getting the deals coming in. You've got to get that financial data. And I don't know if I mentioned that, but what we're after is what we call it's a profit and loss. So I'm going to say a P&L, all right, in a month-to-month format. So what we're going to call that is a T12 or a trailing 12. That's what that's called. So when you see a spreadsheet, and it's a seller spreadsheet like this, and it's January and February and March and April and May, and each month has the data. Each month has its income. And then in the end, you have the year-end total. So that would be like your total for the year, and it has that data there. And so that is what a T12, a trailing 12 is. It's going to go back, it's going to be a profit and loss, the seller's profit and loss of income and expenses. Top half is going to be income, bottom half is going to be expenses, like that. And then you're going to have, and then it's down here and it's going to have your NOI, okay? So this is the data that we're trying to get from those realtors or from a seller, is their profit and loss. It's going to look something like this, month to month. It's called trailing because it goes backwards from whatever current month you're in. So, if we're in May, then it would go back to April of the year before, or March, whichever the year before. April. So trailing 12 in a month-to-month format. I like to try and get these in Excel if I can absolutely help it, because it allows me to manipulate the data. This is where we're going to take that NOI. We're going to look at the seller's NOI, and that's what we're going to use to plug into our calculations to start, calculating out, is this a good deal? We're going to take this NOI. We're going to figure out what our bank payment is, right? So if we borrow the 80-20, let's say we borrow 80% of the purchase price. So we'll say, that's the purchase price. We're going to borrow 80% of that. So what's our payment? That would be debt service. Debt service, we figure out how much that debt service is, subtract that from the NOI. What's left over would be cash on cash, or would be cash flow, cash flow, all right? And then we would take our down payment, the 20%, You divide that, that's your down payment, and that would be giving us our cash on cash. And then you would say, hey, is that cash on cash a high enough number to be worth it to pay the investors, to cover whatever expenses you may have for doing the deal? If the answer is yes, and there is a return on effort, so there's enough cash flow, plus it moves your resume forward and somehow, then you have a deal and you move forward. Deal analysis. All right, so this is going to show you how to get out and actually start finding the deals in this section here. You should really be getting good at analyzing stuff. Remember, rinse and repeat. 3 to 5 deals every week from deal flow. We get them bringing in, go through this. We start analyzing those deals. Once you've done a full analysis on that deal and it looks like a pretty decent deal, the next step is go meet the seller or go meet the realtor. Go out there, take a look at the property, verify the physicality, make sure it's a good location, that it's not in bad shape, do your calculations, and then make an offer, and you'll be on your way to closing a few more deals.